Following is a video of the remainder of our presentation on chapter 14. So let's take a look at the next slide. We continue on in our presentation. We're going to look at the metric called net income as a percentage of sales, and what this metric provides you is basically the percentage of the net income earned as a percentage of sales. And the calculation itself is fairly simple. It's our net income, the bottom line, the last net income element in the income statement, divided by our net sales, or divided by our sales, depending upon which element that you have. So what we're going to do is we're going to take our net income of $72,000 and we're going to divide it by our net sales of $900,000. So we can see we have $72,000 of net income divided by the $900,000, in this case of net sales, and we can see that the calculation comes out to 8%. That means for every dollar of sales we produce, 8% eventually falls to the bottom of the line as net income. Now let's go ahead and take a look at this next slide, which is a kind of a word problem and how we calculate, how we're going to calculate net income to sales. We have this company called Deb Inc., and it reported sales of $700,000. It reported cost of sales of $320,000 and operating expenses of $180,000 for the year. Now it says, using the information, calculate the amount of net income and net income as a percentage of sales and gross profit. So the first thing we want to do is we want to calculate our net income, and what we want to do is go back to our classic income statement, multiple step income statement formula, which is our basically our sales minus the cost of goods sold equals our gross profit minus our operating expenses. Typically will result in operating income. In this case, it results in both operating net income and net income, since we have no additional income or non-operating income or expenses after that. So that's our operating, or basically not only it's our net income, and in effect it's also our operating net income, $200,000. Now calculate net income as a percentage of sales. What we do again is we take our net income of $200,000, which we calculated in the previous box, and we divide it by our sales of $700,000, and that means our net income as a percentage of our sales is 26.6%. Now the next assignment is to calculate the gross profit rate, and we're going to take our gross profit amount, which is $380,000, and we calculated that using the multiple step income statement formula. Sales minus cost of goods sold equals gross profit. So that's how we arrive at the gross profit, $380,000. We divide that then by our total sales, and our gross profit rate will come out to 54.3%. Okay, let's go ahead now and take a look at our next slide. Now we're going to talk about another concept called return on equity. And many times return on equity again is abbreviated, and it's abbreviated as ROE. You'll see that way quite often. So ROE stands for return on equity. And what is that metric? It's a percentage of net income earned based upon the value of the amount of equity invested in the business. The calculation, the return on equity formula, again, is not complicated. It's our net income being the bottom line income for the company. It's divided by the average equity of the company. That means we take the beginning equity plus the ending equity and we divide by 2, which means that's the average equity. So over on the left hand side now we see we have a partial balance sheet and we have a multiple step income statement for the year 2. So based upon this information over here on the left, let's take a look at how we're going to do this computation. Okay, the first thing we're going to look for is our net income. And on our multiple step income statement, our net income is going to be the bottom line income for the income statement. So in this case, the net income is going to be $70,000. And that's what we include in the numerator portion of the equation. Now we have to calculate the average equity in the company. And that is fairly simple in that we have the ending balance sheet for year 1 and year 2, the assets, liabilities, and equity. You'll notice that the ending balance for year 1 is $360,000. So that becomes the beginning balance for year number 2 in calculation of the average. Year 2, our ending balance is $430,000, and that becomes the ending balance for year 2. So we add the $360,000 plus the $430,000 and divide that by 2, and the return on equity in this case is 17.7%. Now, a trend that demonstrates an increase in the return on equity ratio as a trend is generally favorable. Okay, now let's take a look at the next calculation, and this is a story problem. It's a little bit more, because it's a story problem, it's a little bit more complex, and I'll show you how to solve it here. XYZ had a net income of $500,000 based upon total sales of $6.5 million in year number 2. At the beginning of year number 2, the company had stockholders' equity of $1 million. So that's how much equity the company had. Beginning balances for year 2 included net assets of $1,400,000 and net liabilities of $400,000. So that represents beginning of the year information. At the end of year 2, the company had net liabilities of $700,000 and net assets of $2,200,000. Now we're being asked to calculate the company's return on equity. Now again, if we take a look at the formula for return on equity, it's our net income, the bottom line on the income statement, divided by our average equity, which is our beginning equity plus ending equity, divided by 2. But you'll notice here, according to the story problem, I don't have all the information I need. Notice I'm told I have beginning balances in year 2 that had net assets of $1,400,000 and net liabilities of $400,000. But I don't mention equity. And at the end of year 2, it says I had net liabilities of $700,000 and net assets of $2,200,000. But again, no mention of equity. So I need the equity amounts in order to do the calculations correctly. So now I need to remember I do have enough information to fill in. If you take a look at the classic balance sheet equation, assets equal liabilities plus equity, and you learn that from Accounting 210, or you learn that from your basic accounting course. Assets are always equal to liabilities plus equity. So I can use the components that I've been given out of this story problem to plug this into the equation and solve for equity, and here's how I do it. Okay, I start off with the fact that in the beginning of year 2, I had $1,400,000 worth of assets. I know I had that. That's from my description. $1,400,000 worth of assets. I also had $400,000 of liabilities. So if I had $1,400,000 worth of assets and I had $400,000 of liabilities, I must, in order for the balance sheet equation to balance, I must have had $1 million of equity at the beginning of the year. So now I've got my equity at the beginning of the year. Now I move on to the end of year 2, and I am told that my total assets for at the end of year 2 total $2,200,000. So those are my total assets. I'm also told that I had net liabilities equal to $700,000 at the end of the year. So therefore, if I had $2,200,000 worth of assets and $700,000 worth of liabilities, I must have had equity, ending equity, equal to $1,500,000. Now with that information, I can plug in the equation. I can start out with my net income, which I know is $500,000 from our description, $500,000. I also know my beginning equity, beginning of year 2, was $1 million. I also know my ending equity at the end of year 2 is $1,500,000, and I take the average of that divided by 2, and that means my return on equity is equal to 40%. Now let's go on to the next concept of what we call earnings per share of common stock, or again, it's typically abbreviated as EPS. And this represents the amount of net income, in other words, the bottom line income, earned that's attributable to each share of common stock. Now, again, over on the left-hand side, you can see a partial balance sheet of Computer City, and I've only included the stockholders' equity section here because that's all I'm going to need for Computer City to do a computation. I'm also included a partial balance sheet for the income statement, and you can see I have certain components of the income statement. Now the formula for the metric is my net income, which is, again, is my bottom line income, the $72,000, and it's divided by the shares of common stock outstanding. The shares of the common stock outstanding are normally the number of shares outstanding are normally placed on the balance sheet itself. Here we have capital stock, and which is common stock, 15,000 shares issued and outstanding. So that's where I find my common stock. It's typically listed on the balance sheet, the number of shares of common stock. If it isn't listed directly on the balance sheet, it's going to be listed as a footnote to the financial statements. So now I have my net income on my shares of common stock. It's now a simple matter of doing the calculation. I take my net income, which is equal to that $72,000. I divide it by the 15,000 shares, and in this case I come up to an earnings per share balance of $4.80. Now let's take a look again at a word problem. And in this case, we have a company or an organization called Cane Garden Bay. And Cane Garden Bay had gross sales of $2.5 million. So that's their total sales. Their cost of goods sold was $1,600,000. And Cane Garden Bay had G&A, in effect operating expenses. Remember, general administrative expenses are part of operating expenses, so $600,000. We're also told that the company had 200,000 shares of stock, common stock issued and outstanding. So the first question is, what is the gross profit ratio for the year? So we're not told what the gross profit is, but if we remember our classical multiple step income statement, it's our sales minus cost of sales equals gross profit. And you can see I've done that right here. I have $2.5 million of sales. I subtract out my $1,600,000 cost of sales. So I end up with a gross profit of $900,000. Now I can compute the gross profit ratio. And that's a matter of I'm taking my gross profit of $900,000 and I'm dividing it by my total sales of $2.5 million. And my gross profit ratio then is going to come out to 36%. Okay, now the next question is, what is the net profit as a percentage of sales for the year? And again, I have my gross profit, which I simply carried down from my upper statement, and I've included now operating expenses, which are really my general and administrative expenses. Remember, G&A expenses are part of operating expenses, which are $600,000. So I take my gross profit minus my operating expenses, that's a minus side. So I take that gross profit minus my operating expenses, and that equals net income. Now, this would both be equal to net operating income and net income since I had no other non-operating income or expenses. So that would be the same. So now I want to calculate my net profit, in effect, my net income as a percentage of sales. And I can do that simply by taking my net income of $300,000 and I divide it by my sales as a percentage of sales of $2,500,000, and my net profit as a percentage of sales comes up to 12%. Okay, the next item then is what is the earnings per share for the year? So we go back and we want to remember that our earnings per share are based upon our net income. And in this case, our net income is equal to $300,000. Okay, I also know the company had 200,000 shares of stock issued and outstanding. So I take the $300,000 of net income and I divide it by the 200,000 shares, and that means my earnings per share were equal to $1.50 a share. This is a slide on the calculation of what we call the price to earnings ratio, or for short, PE ratio. And this is a ratio of the value that the stock market, in other words, buyers and sellers on the open stock market, place on the earnings of a company. Now, we're going to look at this next slide as an illustration. This next slide is just for your information only. It is not part of your workbook. So let's assume that we have a company called Stable Company, and its earnings per share are currently $5 per share. And remember, we've calculated earnings per share. We did that in our last class problem. So at $5 a share, Stable Company makes a good rate. And that amount neither grows much or declines much. It stays around $5 a share. Now, in contrast, we have another company called GoGo Corporation, and GoGo Corporation was started just a couple of years ago, and its earnings have increased dramatically over the years, or over the last couple of years, and now its earnings per share are $5 a share. Now, if you take a look at this, both Stable Company and GoGo Company have earnings per share of $5. So in theory, you would think that the market would value both of those stocks at about the same price. But the market will not, and probably the major reason in this case is because stable company has got stable earnings and it doesn't go up, doesn't go down much. Go-Go Corporation's earnings are steadily increasing. Now, in this case, I've come up with a theoretical price of $20 per share. That's what the market is paying for stable company. On the other hand, Go-Go Company, because of its growth, the market is willing to pay $60 a share. So what you're doing is the market is paying $60 a share for $5 of earnings per share for Go-Go, while the market's only willing to pay $20 per share for $5 of earnings per share for stable corporation. And again, it's based upon the market's perception of the future of the stock. And Go-Go, the market is obviously perceiving that the EPS will probably grow. So this is premium over stable company. Now we measure that through what we call the price to earnings ratio. And we take the price per share and we divide it by the earnings per share. So let's do that for stable company. So if we take $20 a share and divide it by, or $20 per share and divide it by $5 EPS, what that means is we are paying 4 times the earnings per share for stable company. In the case of Go-Go Company, we are paying 12 times the earnings per share. So you can see that the market is valuing Go-Go at 3 times the amount that they're valuing stable company at. So that's the process that we're going to use for our price to earnings calculation. So if we take a look at the PE formula again, it's basically our stock market price divided by earnings per share. Now we have a company called McMatter Corporation that reported earnings per share of $2.50 for the year, so that's our earnings per share. The corporation's common stock was trading for $30 a share, so that's what it's worth on the stock market. It asks you to compute the price to earnings ratio for the common stock. So we're going to apply this formula to the information in the word problem. Okay, our stock market price is $30 a share. The earnings per share are $2.50, and we do the division of 30 divided by $2.50, and here it shows that that the stock market is paying 12 times their earnings. Now in this case, if we wanted to look at trends, let's assume that the PE ratio was 12 times during this year, then a year from now it's 12.5, then a year after that it's 13. That means the trend is increasing. And in that case, what that means is the market's willing to pay more for the equivalent earnings. So that's a favorable trend for the company. So in this case, it would be favorable. Okay, now let's look at the next calculation, and it's called the dividend yield calculation. And the dividend yield calculation is a percentage of dividends earned on a share of stock based upon the amount paid for that share of stock. So here we have Computer City, and the stock currently has a price of $96, and let's assume that an investor just bought that stock. Computer City declared cash dividends to be paid to all shareholders at the rate of $4.80 a share. So what we want to do is calculate the dividend yield formula, and the dividend yield formula is the dividend that is being paid divided by the price we paid for the share of the common stock. So again, looking at the word problem, the dividend paid was $4.80 divided by the $96 market price of the stock, and that means we're earning 5% based upon the dividend, based upon what we paid. And that's the dividend yield stock. Okay, now let's look at what we call the financial statement ratios exercise. And here at the top you're given a number of different financial statement ratios, and down the slide here it says, from the following ratios select the appropriate ratio to best answer each question below. So the first one is, I want to measure how efficiently accounts receivable are being collected. So if you remember from our cash cycle, we go from cash to inventory. There we measure inventory turnover. And that inventory then is converted to a receivable, and there we measure inventory turnover. So that would be the accounts receivable turnover ratio. Okay, now the second item is I hold 5 shares of Google common stock. I want to know how much of Google's net income will be applicable to my share of common stock. And again, what I'm looking for is something that measures net income divided by my share of common stock. And in this case, the correct ratio would be earnings per share. There's the earnings per share. I want to know what would be the best measure of a company's ability to sell off its most liquid assets to pay off its current liabilities. In other words, I want to be able to liquidate my current assets, those assets, as quickly as possible. That would be the quick assets ratio, or again, it could be the asset test ratio. It means the same thing, but that would be the quick ratio. Okay, I am a creditor who's considered loaning money to ABC Company for 15 years, in other words, in the long term. What ratio trend, being a creditor, would I most likely consider to measure ABC's long-term credit risk? Remember we said that we talked about the debt ratio, and that's the answer, debt ratio. And what that means is as my debt ratio goes up as a percentage of assets, there's a chance if I have a business downturn, I won't be able to pay my debts. So the debt ratio is a good measure of long-term liquidity. Okay, the next one is I'm an investor who's interested primarily in receiving dividends for a stock. What metric am I most likely to consider? So I'm an investor and I don't really care about the growth of the stock. Oh yeah, I'd like the price to go up, but I'm investing for the dividends. So I want to basically invest in the stock that'll give me the most bang for my buck with dividends, and I would measure that utilizing the dividend yield ratio. So that would be dividend yield ratio. Okay, the next one. I have been asked to identify common stocks where the stock market places significant values on the company's earnings. What metric must I use? And that's basically the metric from our 2 slides ago, and that would be our price to earnings ratio up here. There's price to earnings ratio. I want to know if a company has sufficient liquidity to operate over the current year under normal current operating conditions. Now, actually, you could have 2 different measures here. Here's the one I wrote down. It would be the current ratio right here. But also you could use working capital, because working capital is the current assets over the current liabilities. The current ratio is simply the ratio of the current assets over current liabilities. So either of these measures or metrics would work. And the last metric, or the last item here, is kind of a duplicate of one of our other calculations. But what metric would I use to measure how quickly a company is collecting in its accounts receivable? And again, that would be the accounts receivable turnover ratio. Okay, you have an exercise here that talks about financial statement ratio trends. And what you need to do is indicate if the following ratio trends are favorable, unfavorable, you cannot determine. So evaluate each of the ratios based upon its own trend only. So let's start out with trend number 1. We have a decrease in the price to earnings ratio. So what that means, if you remember the meaning of the ratio, is that is the amount that shareholders or the stock market is willing to pay for the value of a company's earnings. So in theory, if the price to earnings ratio is increasing, that would indicate that's a favorable trend. In this case, since it is decreasing, that would be an unfavorable trend. Okay, now let's take a look at the debt ratio. The debt ratio is a percentage of assets that have been acquired in the company but have been acquired through third-party debt. meaning that as the debt ratio increases, in effect, the risk of liquidity to the company actually decreases. Assuming that a company takes on a lot of debt, they do have to pay that debt back over time. And if the company suffers a economic setback and decrease in their earnings, their decrease in their revenue, what's going to happen is they're going to be less likely to pay off any type of increased debt. So in this case, the ratio would be an increase in the debt ratio would be unfavorable. Okay, now we have an increase in quick assets ratio. If you remember, quick assets are those current assets that can be converted into cash very quickly to pay off current debts such as in an emergency. Now, the quick ratio means that the ratio of those quick assets to the current liability is actually increasing. So what that means is that as the ratio increases, we have more quick assets to pay down the current liabilities. So that would be considered favorable. Okay, decrease in accounts receivable turnover ratio. And the accounts receivable turnover ratio is a measure of how quickly you collect the entire balance of your accounts receivable. So if I have an accounts receivable turnover ratio of 5 times, that means I collect my accounts receivable 5 times during the accounting period. So therefore, if I have if my ratio is 5 times and it goes up to 6 times, that's an increase. And that would mean the increase in my accounts receivable turnover ratio means that I would be collecting my accounts receivable more efficiently. So in this case, this is a decrease in the accounts receivable turnover ratio, so it would be unfavorable. The next to last one is a decrease in working capital. And what that can be defined as the value of your current assets minus your current liabilities. So if you used all of your current assets to pay off your current liabilities, what's left over in the current assets would be considered your working capital. So your working capital as it grows means that you have the current assets over current liabilities is also growing. So an increase in working capital would be favorable, and the opposite is a decrease in working capital would be unfavorable. And the last item is an increase in return on equity. That represents the net income of the company divided by the average equity within the company. So if your net income increases relative to your return on equity, that would mean you would have an increase in return on equity. And under those circumstances, you'd be increasing your net income over your average equity. So that would be a favorable trend. And that's the end of the presentation for the last problem in our workbook. Thank you very much.